Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth. What's up, guys? It's Mr. Fit to Flourish, and this is part 5 of the options trading course. So let's get right into it. No wasting time. Let's get into it. All right, so we stopped off here at the delta to contract price ratio. So last time we talked about volume, we talked about what delta is and how with every dollar increase or decrease in the underlying, that's going to be how much delta is going to tell you how much you're going to gain on your contract. Okay, so in this case, let's say your premium is $1, which just means that you're paying $1 for this contract. So $100 because you're controlling a block of 100 shares. So your premium is 100. Your delta is 50. So this is a 50% ratio. Your delta to contract price ratio is 50%. So this basically means that for every dollar move you get in your underlying in the stock, so if the stock goes up $1, then your calls are going to go up 50% just off the bat. And this is because the delta tells you how much you're going to gain on your option contract for every dollar move. So I look at this delta to contract price ratio a lot of the time when I'm day trading. I'll look at these low cost contracts and I'll look at the stock that I'm trading. Certain stocks might have different deltas and different contract pricing, et cetera, et cetera. So I'm always pretty picky about, okay, what am I trading? I'm trading SPY, I'm going to trade QQQ, I'm going to trade IWM. Like these 3 ETFs are really, really, like the contracts are super cheap, and then you'll get really good deltas and really good movement overall. So $1 move in the underlying means that your contract gains 50% off of a $1 move in the stock. I usually target like a 20 to 40% ratio for my day trades. So that's pretty much like going 2 to 3 to even sometimes 4 strikes out of the money. Okay. Choosing options. So there's different ways to choose options, and it all depends on your goals. So people are always like, oh, what are you doing? What are you doing? I'm like, I day trade. I don't care about anything else. I don't care about your shares. I don't care about your crypto. I don't care about your Forex. I don't care. Okay. I'm solely focused on going long calls and puts. That's it. I don't care. I don't care about strategy, straddles, whatever. Anyways, if you do want to indulge in these other things like swing trading or long term, look at this. This is how you choose options. Okay. Weekly options expire with Friday dates. Okay, every 7 days. A monthly option, the name of the option on the 3rd Friday of the month. Options with further out expirations are less volatile. They're going to cost more money because they are more stable. So you're paying to play. You're paying for that theta. Okay, and then options with further out expirations are prime for swing trading. Okay, swing trading, holding options for more than a day. Okay, so options that expire sooner are more volatile, can lose money quicker, but they can also provide bigger percent gains faster. Okay, and they're usually used for day trading. So if you use Robinhood, like this is what the options settings would look like. You would hit trade to trade something like Apple, and then you go to view options, and then you would see something like this, and this is pretty much an options chain. So here in this case, Apple was trading around 229, and then you can see like these are puts, so these are in the money here, and then these strikes would be out of the money. So out of the money strikes are usually cheaper. In the money, you have intrinsic and extrinsic value, so they're going to be more expensive. Okay, so if I was going to buy a put, one thing I want to point out here is like this is your Greeks. So you have your delta, your gamma, your theta, vega, and your rho. Okay, so all that stuff, and then you have your bid and your ask. You have your IV of less than 50% is what we're looking for if we're swing trading. Okay, so 22% IV is really good. Then you want to look at your volume and your open interest. So your open interest tells you how many people are holding on to those contracts from like the previous day, and then volume or previous times they're still holding on to the contract, and then your volume, open contracts. Your volume is going to tell you how many times that contract was traded on that particular day. Okay. So day trading options. So the best options to contracts to choose are usually close to expiration if you're day trading to capture bigger percent gains. Okay, so 0 DTE you can do if there's huge momentum, but you really don't want to be doing this because it's pretty risky. There needs to be obvious movement in the stock, and it needs to have a good just quick move. There needs to be a lot of momentum. There needs to be good opportunity, or else just don't trade 0 DTE. Otherwise, trading a 1 DTE, so 1 day to expiration contract, it doesn't get killed as fast. So your theta is not crushing the contract price as quickly as it does on 0DTE, and it gives you some time to do an intraday swing. So otherwise, trade one day to expiration to the same week's Friday expiration. So like the 7-day to expiration contracts, if you're day trading. Okay, you really don't want to be day trading like a monthly contract, something that's like 3 weeks out, because you're not off of like a dollar move. You're not going to make a lot of money. Okay, so you want to do something more volatile. And then usually I like to go 2 to 3 strikes out of the money. Sometimes even 4 to 5 strikes if there's big news or a big move is expected. Okay, because I want to capture that delta to contract price ratio, especially when when the contract is further out. The delta to contract price ratios are usually pretty big. They're usually really, really big. Okay. So choosing options that are too far out of the money, they're very cheap. They might not move well if they move at all. Sometimes they don't move at all, and you can lose value really quickly. So this is something that is like, it says 0.05, which means you're paying $5 for a contract. I do get those contracts sometimes, but like I said, it needs to be big news, because those $5 contracts can go to $100, which is a 20x. So that can happen, but it's not likely all the time. And if you get that $5 contract and the stock is not moving in that direction you thought, that 5 can go to 1. It can even go to 2, and you're losing half of what you put in. So they're very volatile. So yeah, be very careful. All right, so swinging options. So the best contracts to choose for swinging are 3+ weeks to expiration. Okay, so you need to go at least 3 weeks out. Okay, if you're going to be holding option contracts for 2 to 3 days or more. Okay. And then I usually like to go out of the money 4+ strikes, based on the stock's volatility and based on the expected move. But this is just like a base structure, but you need to understand your stock's average daily range and make the calculation of, okay, I'm expecting it to go here. This is how much I'm expecting to get out of this trade, et cetera, et cetera. But this is just a basic overview of how to choose swings. You can always choose swings in the money too. So a lot of what I'm showing is like how to get like money quickly type of thing, but just a base. You can choose in the money, at the money. I personally like out at the money because, again, delta to contract price ratio, and you can make bigger gains faster. Also, take note, the stock price does not need to hit the strike. Okay, so when you're getting these out of the money strikes, a lot of people were saying like, oh, I don't want to get it because I don't think it's going to hit that number. Well, the stock doesn't need to go up to that number. So for instance, if Apple's trading at $200 and you choose a $220 strike, you know Apple might not go to 220 like in a week, but all it needs to do is move towards that direction. So if it goes from 200 to 205, you're making a lot of money. Sell your contract. It doesn't have to hit that $220 strike price. And a lot of people don't know this, which is I didn't realize, but a lot of people don't know this. You don't need to hit the strike price. The strike price is just the contract that you're picking. It's literally just a contract that you're picking, and then that contract is what you're trading. The contract is going to increase in price as long as the underlying moves in the direction of your strike. Okay, so every dollar move in the direction will cause an increase in your contract price. So you can buy and sell the option contract at any time before expiration. So this concept changes the game. Okay, you need to understand that. And then again, 0 day to expiration. They're very risky, so don't do this, especially if you're a beginner and you're just learning about it. You're hearing options, yeah, you're cooked. Don't do this. Anyways, this is when you trade options on the expiration date. The volatility is typically 90% or more. Option prices fluctuate fast. You can lose the worth of your entire contract in seconds, but you can gain hundreds of percent in seconds. Okay, so it takes a lot of experience to trade on these days. Only trade these if you are going to trade them. You only want to trade these when there's clear trend, clear direction, a breakout, or like some huge momentum, some news, or else you're gonna get stuck in consolidation and get chopped up in your contract prices. You might have bought it for 100, and then 5 minutes later it's at 50 or like 40, and you just lost 60%. So be very careful with that. So what am I looking at on Robinhood? So on Robinhood, this is what I'm seeing. I'm seeing this screen. Okay, I'm gonna trade QQQ. I hit trade. All right, I hit trade. Then I'm gonna go to trade options. I'm gonna see these dates. These dates up at the top. Okay. I'm going to probably just do a day trade. So I'm going to do a 0 day to expiration. So if it's September 9th, I'm going to click on September 9th. And then I'm looking at puts. I'm going to click puts. I'm going to buy puts. Okay. So it says currently the price of QQQ is 446.77. So I like to go 3 to 4 strikes out the money. So I'm looking at these options here, $96, $77. I'm looking at these. I'm like, okay, these look pretty good. Okay, so looking at these puts, and yeah, they look pretty good. So I would end up getting one of these puts. Okay, and then the ones that are way too far out of the money are like, if the current price is 446, and you're picking like a 431 put, you're cooked. You're cooked, because this is $9, $8, $7, and then $7 again. You know something's wrong here. These options are not selling. They're not selling. But $15 out of the money, 15 to 20 strikes out the money is way too far. Unless you know there's going to be a crazy market event, then I'd buy a ton of these. But those market events are like black swan events, like kind of like the FOMC that happened on the 18th of December this year. Okay, so we had a huge sell-off. Markets were panicking and selling everything. Then you would get one of these because they would go crazy. Otherwise, you don't do that. Anyways, so we click on that 442 put, and you can see here the bid-ask spread is 75 and 77. There's really good volume, 8,647 contracts being traded, or the contract was traded 8,647 times. Okay, and then the delta is 17, and then as you can see, the mark is going to tell you like what the price of the contract is really. So 76 to 17, so that's over 25%. So yeah, that's about 25% per dollar move. So if QQQ moves from 446 to 445, you just made 25%. Okay, so that's that. So here's an example. So here's an example of a trade. So pretty much I'm getting puts, and this is QQQ. So in this case, QQQ had a break below this neckline. So I would enter here after this big move to the downside. We had a retest, but whatever. Contracts were worth $50 here, and then once we moved down, now they're worth $80. Then we moved down 120, and then we moved down here. They're worth $210 per contract. Okay. So this is an example of getting puts at 458, and we got the 454 strike puts. The contract was worth $50, and then as we get closer and closer, we increase in price. And then once we get in the money, so once we actually get below 454, because we got 454 strike puts, then we get a lot of intrinsic value added as well. All right, and then leaps. So what are leaps? People talk about this a lot. So leaps are long-term and equity anticipation securities. Basically, just means it's buying option contracts that expire a year out. Okay, so you might want to do this if you can't afford the actual stock, and the option is cheaper. But then also you'll get a bigger percent gain a lot of the time by just buying the option instead of buying the underlying. Because like Tesla might be $400 and it goes to $440. All right, you just made 10%, but that $40 move on Tesla caused your leaps, your option contracts on your leaps, to go up probably somewhere like 50 to 60%. Okay, and Tesla only went up 10%. So it makes sense to leverage sometimes by getting leaps. So they expire in more than a year. They're ideal for long-term positions. They're cheaper than holding the underlying position sometimes. They do have high premiums because you have a lot of time. They're less sensitive to movement of the underlying. And then data starts to get impacted with 60 days left to expiration. Okay, so option resources I recommend. So Options Trading by Ann Loeb, Understanding Options by Michael Sincere, and then the websites would be like Options Profit Calculator, Maximum Pain, NASDAQ, and then of course my YouTube channel. Okay, so all that goodness. So that concludes it pretty much for this options trading series. So this is part 5. Hopefully you guys learned a ton. Go back and watch the entire series. This is how to trade options. Literally everything you need to know about options, from what it is, how it works, what it relates to. It's just buying insurance on a stock. So let's keep winning. Let's keep winning.